Okay, CVP. So CVP analysis and computations, this is where we are right now, guys. We are the halfway through the chapter, and we're going to talk about the CVP analysis by itself. Guys, let's just remember what we did at the beginning of the lecture. So this is my CVP analysis. Looks like an apple, but it's not. Okay. So this is CVP analysis. What we did so far, we talked about break-even points, right? We talked about break-even points, we talked about break-even analysis, we talked about other dimensions in the break-even, and then now what we're going to do, we're going to talk about the simulations. Guys, let me just remind you that decision making over here, making over here. Okay, CVP analysis is the entire circle. Okay, it's the entire concept, and the CVP analysis is a tool, is a logical extension of the break-even analysis, and it brings us the clear internal assessment of the operations based on, again, costs, sales volume, and the profit. Okay, so we are done with the break-even point. Now what we're going to do, we're going to talk about the CVP simulations and decision-making process. Okay, guys, and under the CVP analysis, I will have to tell you a couple of things before I show you the in-class exercises, before we talk about the entire CVP concept. So you will get to differentiate the dynamics between break-even analysis and the CVP analysis. Okay, let me just clean this real quick, and then we'll get to point. Guys, as I said, the most important difference between CVP analysis and the break-even analysis, remember, break-even analysis is in CVP analysis. Break-even analysis is the heart of CVP analysis, and CVP analysis is the entire concept along with the simulations and decision-making process. Okay, guys? Therefore, CVP analysis can be applied to several different situations in the operations. Those situations are solely based on cost structure, sales volume, and the revenues, and therefore profits. Okay? We have changes, in CVP analysis. Imagine that hospitality operations are dynamic. Why? Because revenue items are changing, revenue generation is different every single day because of the different occupancy percentages, different customer traffic, and therefore VC items will be affected, or fixed cost items will be affected by that. Okay, guys? The changes are those changes in revenues, changes in variable costs, changes in any other operations. It will also affect the entire CVP analysis and therefore the break-even analysis, and the entire thing. Okay, we will talk about all these. Also, another most important difference between CVP analysis and the break-even analysis. So far, in the break-even analysis, we have focused on the only one product. We have focused on rooms only, we have focused on one department only, or we have focused on the entire rooms operations. In the CVP analysis, we will also focus on the entire departments, individual departments, and then let me just and then we are going to get to analyze the entire operation by a clear breakdown of individual departments, guys. Okay, so let's start analyzing different CVP situations. Okay, before that I would like to check my microphone if it's working. Yes, okay, thanks so much. Let's analyze different CVP analysis, guys, different CVP simulations. Again, differences are out there. We talked about differences right now. Let's see what can happen in CVP analysis based on different situations. ICANN Hotel, ADR, according to financial data of the ICANN Hotel, ADR and UVC for the current period are $80 and $25 respectively. Okay, dealing with, let's just ICANN Hotel. Okay, just label it clearly. Suppose that the property lease is about to end and the new lease will cause FC to increase by $40,000. Let me stop right here. Guys, fixed cost, as we know from the previous video lecture, fixed cost does not change during the short term and the mid-term. However, fixed cost does change for the long run. How? Lease expenses, rent expenses, loan repayments, hazard insurance, insurance expenses. These are the most important, or the wages. I'm a salary people. These are the most important fixed cost items in hospitality operations. So if there is a change in the fixed cost, remember the graph. Let me just do the graph again. If there's a change in fixed cost, or let me just back up and tell this to you, if there's a change in any cost item, revenue item in the operation, along with the sales volume, of course, CVP analysis, CVP situations, along with the break-even points, break-even analysis will also change. So remember, this was our graph, correct? TC right here. And remember, there was a hidden line over here, and that was the fixed cost, horizontal line. And difference between TC and the VC is the variable cost, because we know TC is equal to VC plus FC. We know this from the second chapter. So for the ICANN hotel, look, fixed cost will increase by $40,000. What's going to happen to fixed cost is that now this is the current fixed cost item right here. Imagine that fixed cost is going to increase, which is the purple line, fixed cost prime, is going to increase by $40,000. If the fixed cost increases by $40,000, take a look at my new, let me just sort this right here. Oops. My new break-even point will be around here. Okay, guys? Which means increasing the fixed cost will also shift my break-even points upward, will also increase my break-even points. In other words, I have to sell more to cover that fixed cost and still be at the break-even point. Bottom line, let me clean this. I will draw one more time when I show you the example. Bottom line, if there is any change in the operation, such as increase in fixed costs, increase in sales volume, decrease in variable costs, any other changes like this, it will change your break-even analysis, therefore your CVP analysis. So we have the fixed cost increase by $40,000. The question becomes, based on the changing fixed cost, how many more rooms must be sold now? Because fixed cost was right here, right? But it is shifted right now. So shifted, increased fixed cost will also increase the break-even points upward. We have to sell more now to cover that increase in our break-evens, and then therefore CVP. How many more rooms must the management sold in order to cover the increased fixed cost and to still be at the break-even? Guys, this is one of the most important changes and simulations in CVP analysis. We have to factor in the increase in fixed cost, and then we have to find out how many additional rooms we have to sell to cover the increased in fixed cost and to still be at the break-even. The equation we're going to utilize is this right now. Additional rooms to be sold after increase in the fixed cost is equal to increase in fixed cost over, in parentheses, SP minus UVC, and this becomes our, close brackets, this becomes our equation. So we know what increase in fixed cost is. It is $40,000 right here, over SP is given $80 in the question for ICANN, and UVC is given $25 for the ICANN, parentheses first, then the division right here. Now we have to sell 727 additional rooms than what it was before to cover the increased fixed cost and to still be at the break-even point. This is one of the major changes, simulations in the hospitality industry. Guys, why do we need to deal with this? Because here's the thing. Hospitality industry by nature, remember the first chapter, by nature, hospitality companies need to invest in physical properties to grow. Okay, financial growth, operational growth, market size, asset base, you name it. Well, if as a company, if you keep acquiring additional assets, it will increase your fixed cost because you have to pay more insurance expenses, you have to pay more lease expenses. If you're leasing a property, you're going to pay more as a company. Of course, you're going to pay more salary people because their salaries are fixed on annual basis. Therefore, it will increase your fixed cost. And this is one of the most important simulations in the hospitality industry. Therefore, we have to factor that in, and we have to consider in our CVP analysis. So, bottom line, just to cover $4,000 increase in the fixed cost, in the long run, we have to sell now 727 more rooms to cover that, okay? Guys, again, CVP analysis, until now, we have talked about the entire operation. We did the break-even analysis, which is in CVP, which is the heart of this chapter. And we only talked about the entire operation in terms of occupancy, break-even occupancy percentage, break-even units, and the desired profit, so on and so forth, okay? But as we know that hospitality operations, imagine that lodging operation, lodging industry, lodging companies or restaurant companies or cruise lines, a theme park, you name it, they don't have one department. They don't have just one product. They have multiple products and they have multiple departments. Imagine a hotel and lodging industry. We have we have F&B departments, we have catering departments, we have conference areas, we have rooms department, which is the major sales revenue generator, rooms. We have spa membership, wellness centers, and pool membership, golf course membership, any other additional revenue generators in the lodging establishments. All right. Well, we can analyze the entire bigger picture, but what if we want to analyze individual departments and then come up with the bigger picture? In real life, decision makers and the directors, of course that's the same thing, decision makers, they don't just analyze the bigger picture and then leave their operations at that. They do break it down to different operations. They do combine, keyword combine, they do combine different departments and or products and or services, and then come up with the entire CVP analysis. Okay, guys? So that's what we're going to deal with right now. Take a look. That's what we're going to deal with right now. What we're going to do, we are going to combine different departments in the entire operation, and then we are going to see how the operations work individually in the entire picture, which is the entire operation. Guys, the key question here become, okay, we know that we have multiple departments, we have multiple products, we have multiple services, but the key question becomes, how are we going to combine them? How are we going to combine them so that we can do the individual analysis, and then we can see the clear picture, bigger picture in detail by analyzing every single product or every single department at a combined level. Imagine a hospital, imagine a lodging establishment. Rooms division is the most important revenue generator, therefore the profit generator, correct? Then it is followed by F&B department, then the other revenues. Therefore, the combination of different products or the combination of different departments must be based on individual and unique profit contribution to total revenue. In order for us to measure that, we have to calculate weighted contribution margin ratio, or in short, CMRW, to combine different departments based on their importance, which is the weight, okay? And therefore, we will get to analyze the entire operation in detail, because the contribution of rooms department is not the same with the contribution of F&B department. So it's like comparing oranges and apples, all right? Therefore, we have to give enough importance, which is the weight, to a rooms department. We have to give the most importance, the greater importance to a rooms department than F&B department. When we combine them, it will give us a clear picture that, hey, okay, rooms department are the most important revenue generator, so we can do some analysis, or we can come up with a clear forecasting or budgeting after that, or pricing, okay? Therefore, CMRW ratio is going to help us. We are going to combine the profit, different profit items at the combined level, and then we are going to find the combined measure of products and departments' gross profit margins, okay? Right here, let me just, gross profit margins in the entire operation, guys, okay? So, CMRW, okay, is utilized only if you have two departments mentioned in the question. CMRW is utilized only if there are two products that you're analyzing under CVP simulations. If you have multiple departments and or multiple products, the first thing you have to do to calculate CMRW, because again, you have to combine departments. You cannot combine different departments, let's say rooms revenue profits over here and then F&B profits over here. You cannot combine them without giving the weights. Therefore, CMRW is a percentage when you combine two departments together based on the weights, which is the importance level, numerical importance level. Based on the weights, CMRW gives you a percentage that shows you a combined profit contribution to entire operation, guys, okay? That is exactly why only when you have two departments and or two products, you have to combine them together by calculating CMRW. This is the equation right here. I'm going to go over this in a second. By combining them together, and then you will have to do the simulations at a combined level with all the individual departments, guys, okay? So CMRW is equal to TR minus VC over TR. This TR is exactly the same with this TR. TR, total revenue, minus VC over TR, okay? So let's see how it works. Let's see why we do this, and then I'm gonna use additional examples, additional verbiage to tell you why do we need to combine departments, because you know why, and then how do we do this. So it will be much more clear by running a couple of examples about that, and then we will have to see some different simulations under CVP based on this structure as well, guys, okay? So TGA Hotel Group has two revenue generating departments. Boom, keyword. Remember, if you have two different departments, revenue generating departments and or products, you have to combine them by calculating CMRW. CMRW is individual departments profit calculation, combined profits margin to entire profit and entire total revenue operation, total revenues, okay guys? We have rooms and retail outlets, imagine that, okay? TGA Hotel Corporation, assume that rooms department has total revenue of $270,000 and VC of $110,000. Also, imagine that retail outlets have total revenues of $190,000 along with the VC of $85,000. Based on the information given, what is the CMRW? Again, guys, CMRW is just a percentage. It is the combined weighted contribution margin, okay? Which is, in this case, combination of rooms and retail outlets. Guys, CMRW is equal to TR, okay, minus VC over TR. What we are going to do, since we have two departments, we have to add all the TRs, okay, from rooms and retail department. We will do the same thing for VC, and this guy is same with this guy anyways. Okay, guys? So take a look how we do this. Please switch your attention to the lecture notes. Again, CMRW is equal to TR minus VC over TR. $270,000, rooms TR plus retail TR, which is $190,000, minus rooms VC plus retail VC over the same revenue items. You can see from those two lines over here. When I do this, CMRW becomes 58%, meaning rooms and retail departments, when they are combined, they contribute 58% in terms of profits, 58% to the entire profit structure of that TGI Hotel Corporation, guys, okay? That's exactly what it is. So this is CMRW. Okay, very good. We find it, okay? And we have to find this. As I said before, whenever you're dealing with two departments and or two different products in the same establishment, you have to calculate CMRW first unless it is given to you. Sometimes I will give you CMRW straight up in the question, and then you don't have to calculate CMRW, but most of the time you do need to calculate CMRW, because most of the time CMRW is not given in the question, but individual TRs and VCs are given, so you have to calculate them as well, guys, okay? So let's extend the TGA hotel example, and we are still here, TGA, okay? Let's extend TGA hotel example over here, guys, and then take a look at this. What if management wants to find out total revenue when TGA breaks even with its 2 operating departments? What are we going to do? Guys, so far, let me just do this again so I can get to visualize the question or the simulation by itself, break-even points. What we did so far in break-even analysis, we solve for break-even units, right? And then we solve for break-even occupancy percentage, and then we solved for break-even at desired profit level, some point here, and then we find the additional number of rooms required beyond the break-even point until this DP level, and then we talk about the net loss, okay, the opposite scenario. But have we talked about the total revenue at break-even? We have not. What we're going to do now, okay, one of the most important simulations after the increase in fixed cost, we're going to find the TR at break-even when 2 departments or 3 departments or 4 departments and or products or goods combined, okay, guys? TR break-even, when you can tell from its equation as well, fixed cost over CMRW. Why CMRW? Because for TGA, there are 2 revenue generating departments. We have to combine them together, all right? We have to combine them based on their profit importance, which are called weights. Therefore, we have to utilize CMRW. So, this is the equation for TR break-even. So, we are looking for the total revenues needed at break-even level for TGA along with its 2 revenue generating departments. Okay? Let's extend TGA Hotel Corporation, and then let's see how this works. Assume that TGA Hotel Corporation has an annual fixed cost of $130,000 in addition to the information given previously in the previous example, okay? And what we're doing right now, we have to find the TR break-even when TGA breaks even. Okay, so TR break-even is equal to total revenues over CMRW. Do we know the total revenues? Yes, we do. From the previous example, take a look at my solution, guys. Let me clean this. We know what total revenues are, correct? And those total revenues, along with the variable costs, they determine CMRW. So we know the CMRW, which is 58%. This is the TR break-even formula. Fixed cost is given, CMRW is given. Therefore, I'm going to take fixed cost over given CMRW, 224, 138, 8, right? Okay. 138 is needed for TGA to break even. Guys, I would like to tell you one more thing over here. 224, 138, okay, is needed to be generated by rooms and retail outlets in this structure. Okay, guys? Therefore, this piece of information, it becomes useful because you can, as a general manager, director, operations, GM, VP, decision maker, you can go back to your rooms director, rooms division director, or any other directors to delegate, to tell them in the meeting, in the business meeting, so you will tell them what to do, how much they have to raise in terms of total revenues to be at the break even, okay? So, again, this is not rooms only, 224, 138, please read the explanations. This is not rooms department only, this is not retail outlets only. This is the combined TR that needs to be generated by those 2 departments to be at the break-even for TGA, guys, okay? Well, clearly CVP is not this, okay? We only have we have seen only two situations right so far. What if I would like to make just like break-even that we did? Let me just utilize a different color, different marker. What if, okay? that I would like to find out a certain amount of profit, desired profit right here for TGA. Just like break-even units, just like we did, guys, you know, at BE at DP, we solved for number of units that need to be sold at DP level, okay? Just like following the same logic, now under CVP we would like to know how much revenue that must be generated by rooms and retail departments, okay, to generate a specific level of desired profit. This equation becomes very useful right here, and then we're going to utilize this equation right here. TR including DP is equal to, in brackets, in parentheses, FC plus DP over CMRW. Again, look, CMRW over here, because we have to utilize CMRW because CMRW is a percentage that shows us a combined importance of those two departments. That's why when we are dealing with two departments and or two products, we always have to utilize that CMRW, guys. Keep that in mind. This is our equation, and take a look at this question. The management of TGA wants to generate $100,000 profit right here. Let me just use this. They would like to generate $100,000 profit. Okay, it's doable. How much additional, look at the keyword, how much additional revenue must be generated beyond the break-even point to reach at the desired profit level? We're going to utilize information from the previous TGA examples, okay? What we're going to do, we will have to utilize this equation because first, let's just find out TR, total revenue at this point, which is DP level, because we know TR at this point, okay? And since I'm dealing with additional revenue, if I get the TR level right here, guys, at that $100,000 profit level, and if I do the subtraction between this point and this point, I will be able to find out additional revenue that I need as a decision maker for TGA to generate $100,000 profit. Okay, so TR including DP, FC plus DP over CMRW, 58%. Still, we are still on TGA example. It's 58%, 0.58. We know what it is. It's given in the question as DP is given in the question as $100,000. FC is also given, so $130,000 plus 100,000 over 58. I need 396,552 right here. 396,552 that I have to generate from those two departments if I want to make $100,000 profit. But I'm not done yet because additional. I would like to know additional revenue that I have to generate beyond the break-even point to realize $100,000 profit. All I have to do, I'm going to take this guy, and then I'm going to subtract this guy, and I will be finding the additional revenue that I have to generate if I would like to realize $100,000 profit as TGA. So when I do the math over here, guys, you can see it, 172,414 that I need to generate to be at $100,000 profit. The concept is the same, okay? You know what it is because break-even. This is just like a break-even analysis, but again, we are dealing with two different departments right now, okay? So, and then we are dealing with dollar values instead of units, instead of occupancy percentages, and these are the most common simulations or scenarios under CVP for the hospitality operations, okay, guys? So let me clean this, and then let's keep going. We are not done yet, okay, because one of the most important between, I will have to clean this because we are switching a brand new exercise. When we start talking about CVP, I pointed out that hospitality industry, as in other industries, there are changes, there are operational changes, and those changes are dynamic, which means variable cost changes, fixed cost changes, sales volume changes, revenues changes, customer traffic changes, customer spending changes, sales are changing, everything changes, okay? Just TJ as well. Well, when there is a change in departments, in room sales, in variable cost items, in fixed cost items or anything, if there's a change, break-even CVP will change as well. Okay? If there is a change in VC, revenues, sales volume, occupancy, you name it, the major hospitality operations in cruise lines, theme parks, hotels, or restaurants, if they are changing, if they change, we have to factor those changes in our calculations. So imagine this, okay? We are still on the TG example. Sorry, we are still on TG example, and then we're gonna extend TG example more, okay? Let's read this question, and then let's analyze what's going on. Let me just finalize my graph. Okay, imagine that revenue for both rooms department and retail outlets is increased by 12%. That's the change. Increase in revenues, a change. What? How much? 12% from the original revenue levels. If you remember, in previous TJ examples, we have the TR for rooms department, we had the TR for retail outlets, along with the individual VCs. Now they are changing. What are the changes? Changes are the retail outlet and rooms department revenues are increased by 12% from the original ones. Okay. Also, there is a 10% decrease in VC of both departments. Based on the information given, what is the new CMRW? I'm gonna go back to this. And what is the total room revenue when TGA breaks even? And of course, we are gonna assume that we're gonna utilize the information from the previous examples. Guys, here's the other thing. Whenever we have changes. Whenever we have different values in revenues, in VC, in fixed cost, in anything. Okay, ADR, occupancy percentage, of course. Whenever we have changes. We have to find a new CMRW because the previous CMRW belongs to the operations before the changes, but there are changes right now, so we have to recalculate the CMRW whenever we have a change in any of the cost, volume, or profit items, guys, okay, which is a CVP. So the changes are here. We will have to increase TRs for both departments by 12%, and then we have to decrease VCs of both departments by 10%, and then we will have to find CMRW first, new CMRW first, then the TR at break even for TGA with the combination of those two departments, guys. Okay, there will be a lengthy solution right now. Okay, but I will show you. We're gonna go step by step as we always do. First, we have to find the new CMRW. We know the formula, we know the specific formula of CMRW, TR minus VC over TR. But again, there will be changes, we have to factor those in. $270,000 and $190,000, I'm at TR right now. $270,000 and $190,000 was the original TR levels for rooms and retail departments. But I will have to increase them by 12% by multiplying them 1.12 right now, because in the question it tells me that there are changes. The revenues are increasing. So guys, the reason I multiply by 1.12%, I am adding 12% to an original one. Okay guys? That's why I'm multiplying by 12%. If the increase was 20%, it will be $207,000 multiplied by 1.20, okay? Which means I am adding 20% on top of that 100%, and then I am trying to find out the increased value by 12%. So $270,000 multiplied by 1.12 is going to give me a 12% increase in revenues from the original ones, from the previous ones. And I will do the same thing for the retail outlets again, $190,000 multiplied by 1.12. Minus now, in VCs for both departments, there is 10% decrease. 100%, 12% increase. Now I am dealing with 100%, which is equal to 1.12. Okay? But now, since I have 10% decrease from 100%, from the original one, because original ones are 100%, I have 10% decrease. Now I am dealing with 90%, which is equal to 0.90. Okay, that is exactly why I am multiplying VCs or both VCs by 0.90. Okay guys, $110,000 multiplied by 0.90 plus $85,000 multiplied by 0.90. Okay, multiplication is right here. Multiply by 0.90. And of course, this line is the same TR with the original one. Okay, guys? So make sure you understand this. If not, please ask me questions about that. I will, whenever we have a question like this, I will explain this one more time, so it will be clear. Okay? So I can reduce I can reduce this equation as 515 200 minus 175 500 over 515 200, and 66% becomes my new CMRW because of those changes, and you know what they are. I don't have to repeat them again. Okay, so this is the new CMRW. I am not done yet because I will still have to find the TR at break even for TGA with the changes for for the combined departments. Therefore, all I have to do, guys, I'm going to take the TR break even formula, okay? TR break even formula, which is, you know, FC over CMRW. This CMRW is 66% this time because it's the new CMRW. FC doesn't change. When I do the division, 196,970 right now. Look, 196,970 becomes my new TR at break-even point. 196. This is not 1 right here. It's 196. Okay. So there is a conclusion right now, guys. I would like to talk about this. I would like to discuss this because numbers are nothing by themselves, because you have to, or sorry, not you have to, but you should be able to interpret them. Okay, the effect of 12% increase in revenues for both rooms and retail departments and a 10% decrease in VCs for both results in break-even points, TR break-even points, shifting from 224,138 to 196,970. So look, let me just try to do the math. It's almost $29,000, $24,000, almost 25, 29, 24, sorry, 29, almost $29,000 difference. So the question becomes right now, do you want your TRBE levels high or low? What do you think? Of course low. Why? Because you will get there quicker, sooner, correct? That is exactly why 12% increase in the revenue items for both departments and 10% decrease in VCs for both departments results in a decreased TR at break-even levels, and that's very beneficial to the TGA. You can also understand from the 66% CMRW, because CMRW was 58.72, I believe, if I'm not mistaken. It was 58 point something percent. Now the overall combined profit contribution of rooms and retail department is 66%. So when I combine their individual profits together, it is increased as well, which is a good thing, because CMRW, if the CMRW increases, okay, your TRs or break-even points will decrease, and that's what you want, because in that way you will realize higher amounts of profit in the operation. So these are the interpretation that you need to extract, you need to take away from the numbers, because numbers by itself, they don't tell anything. As a decision maker, you will have to interpret, so you can come up with a healthy financial strategy. We have a last simulation that hospitality operations and industry utilizes a lot, and that is called the sales mix. Okay, guys, sales mix concept, I would like to, this right here, sales mix let me just clean this again. Sales mix concept is defined as the individual sales contribution of a particular department to an entire sales operations or sales volume. Okay, for example, as we know that I'm going to utilize the hotel industry again, as we know that the rooms department has the major and the most, the biggest, let's say, biggest contribution to the entire sales along with the revenues, correct? Because of the room sales. So if the rooms department contributes 60, or if the rooms department sets 60% of the entire sales, the sales mix of rooms department becomes 60%. Therefore, sales mix shows the individual sales contribution of each department in the entire operation. And of course, it is important because we are in CVP analysis, we are dealing with multiple departments. Imagine this. You have 5 different departments, okay? Department number 1, 2, 3, 4, and 5. And as a decision maker, it is a key practice to know individual departments break-even levels, individual departments TR at break-even levels, individual departments BE units, okay, individual departments BE at DP level, and so on and so forth, right? Because when you see individual departments break-even analysis and CVP analysis in the entire operation, guys, forecasting, pricing, budgeting, staffing, cost control, purchasing will become so easy, and then it will make the operations realize higher amounts of profits. Okay? That is exactly why sales mix concept becomes very important under CVP analysis. Davonte Beach Resort is the example right now. Davonte Beach Resort Management wishes to reach a desired profit of $115,000 during its peak season. Historically, it is known that sales mix of the rooms and F&B departments is 80% and 20% respectively, meaning 80% of the entire revenues comes from rooms department and the remaining 20% of the entire total revenues comes from the F&B department. Assume that fixed cost is $130,000 and the CMRW is 58% for Davonte. With a given sales mix structure, the management would like to know the total revenue needed to be generated by the rooms department only. Look. So they have their entire structure, the entire operation. They have 2 departments only. Let's imagine that. Okay, it's an assumption. There are rooms and F&B, and they would like to know the TR that should be generated at the break-even by rooms department only, not a combined level. Okay, guys? So again, I don't know why I sometimes keep erasing this, but that's fine. I think it's okay to draw this for every single question. Okay, for Davonte, right? Davonte. Let me label it. Davonte is Davonte. Okay. So that's what I would like to know right now. TR at BE by rooms only, question mark. Okay. What am I going to do, guys? I'm solving for TR at break even. There are 2 departments. CMRW is given. Again, whenever you have 2 departments, you have to find CMRW. Unless CMRW is given to you. In this case, CMRW is given to you. First thing you have to do, okay guys? Excuse me, first thing you have to do, let me show you when talking with the equation. First thing you have to do, you have to find the TR including DP level right here because they would like to make $115,000 profit. Right? First thing you have to do, let me just erase this because I apologize, I thought it was talking about TR break even. No, it was that TR at DP. Okay. They would like to make a $150,000 profit, okay? The first thing you have to do, you're gonna find the revenue levels that you have to generate in order for Davonte to make $115,000 profit. TR including DP is equal to FC plus DP over CMRW. CMRW is given, DP is given, FC is given. $130,000 plus $115,000 over 58%. Guys, when I do the math, I need, as Davonte, 422, 414. This is the revenue levels. This is the revenue I have to generate in order for me to generate a profit of $115,000. Correct? Correct. But this is the combined revenue I have to generate. The combination of rooms and F&B department. So how am I going to break it down to find out the only contribution of rooms department in the entire structure? Guys, again, this TR is the combined TR by rooms and F&B departments. But I would like to know the individual contribution of rooms department to the entire total revenue in order for me to generate $115,000. In other words, I would like to know how much do I have to generate from rooms department so I can reach my target of, which is the profit of $115,000. All I have to do, I will need to break this down by the sales mix, 80%, as you remember, as 20%. 80% rooms and 20% F&B. Okay, guys? So if I take 80% of 422, 414, multiply by 80, I will be able to find out how much I need to generate from rooms department only in order for me to satisfy these criteria right here. Therefore, TR rooms, which is this guy right here, will be equal to sales mix multiplied by total revenue. Total revenue is this. Sales mix is 80% given in the question. When I do this multiplication, guys, okay, I will find out the TR for rooms only, 337, 931, has to be generated by rooms department only because of 80% sales mix, okay, so that that revenue generation can contribute to TR at the desired profit level, and of course the remaining has to be generated from F&B department. So this is the breakdown of TRs at DP level or TRs at BE level, okay, when you have two departments under CVP, and you can break it down by the sales mix, guys, okay. And then you will get to analyze, you will turn your face to rooms division department, and then you will tell them their target, and they will try to upsell. For example, they will try to allocate more rooms to OTAs maybe instead of 5% to 10%, or they will, you know, do the right pricing to raise additional revenues to hit their target, okay. Therefore, $115,000 profit will be generated. Of course, as a GM, as a decision maker, you will do the same thing for the F&B department, and this is how it works, guys. Every single day, this is how it works in the operations, okay? Of course, you won't calculate anything by hand. Everything will be calculated by the softwares because we're in the technology era. It's great. However, if you don't understand the numbers, I keep telling this to my students, so everybody, if you don't understand the numbers, you just cannot make a healthy judgment about your operation, and then unfortunately you won't be staying at that chair as the GM or as the director of operations or the hotel manager or the theme park manager or which branch in the hospitality industry you're in. You won't be stay there more, okay? Therefore, I just put some implications over here. It becomes very, very important because you should be able to do a lot of takeaways from those numbers. For example, carefully controlling variable cost help generate more revenues. Of course, when you carefully generate the variable cost, it will increase your contribution margins for each department, and when you combine all these departments, it will increase CMRW, at the same time decrease the break-even points, okay? And that's what you need. If the contribution margin is increasing, BRs are decreasing. I mean, BEs, TR at BE units, BE occupancy is decreasing, and that's what you want, because you will get to, if you get to the break-even points quicker, the remaining will be a pure profit to your operation, okay? A possible increase in fixed cost in the long run, increasing total revenue in the break-even, of course, because you will have to sell more to cover that increase, all right? Since the management cannot control fixed costs, firms should compensate that increasing fixed cost by trying to decrease variable cost. For example, F&B operations may be repricing. For F&B operations, maybe a training of the employees to upsell more, or the portion cut, or the rearrangement of portion sizes, maybe changing vendors or suppliers for the raw products. Okay, taken all together, the key practice is to increase net income over here by decreasing TR at BE, by decreasing BE units, decreasing BE occupancy. Therefore, you will get what your target quicker, and that's what you want. Of course, increasing net income in your profit and loss statement, in your income statement, is the entire key here, guys. Okay. So this was the chapter. This was the CVP chapter. I hope you enjoyed it. Again, if you have any questions, please do not hesitate to contact me by email, by just coming to my office, room 254. I will be very happy to sit down with you and answer your questions. Please follow the course schedule. Please try to stay on top of everything, and don't miss any deadlines for the quizzes and for the homework sets, and for the tests as well. So you will be achieving good grades over here, which is my ultimate goal, anyways. Along which is, you know, increasing your intellectual capacity, intellectual thinking, guys. Okay. Well, thank you so much for watching this video lecture, and I'm going to see you guys in chapter 4, which is the pricing chapter. We will be utilizing chapter 2, chapter 3, the concepts a lot, because there are a lot of correlation, there are high correlation among the chapters. So please understand, read the chapter if you don't understand, and you can always go back and rewind and then listen to lecture one more time. Thank you so much for that, and I will see you guys in the pricing chapter.